Welcome back everybody to the channel, and this week we're talking about crypto staking. And I know we've been doing a lot of crypto videos lately, but trust me, this is a good one. You're going to want to watch it. So essentially we talk about staking, which is using your cryptocurrency in your actual crypto wallet and using it to stake using your coins and earning interest over a certain period of time if you're a long-term investor. This is a great way in order to earn some income on the side if you're looking to be in the markets long-term. And there's a lot of little quirks and features involved with it. So we're going to go through that today, and I'll show you everything there is to know about crypto staking. So we'll see you guys next week. Welcome back everybody, and this week we're talking about crypto staking, and this is an important one. So we're going to break this down into several different areas. So what is staking? Staking, interestingly, is much like cryptocurrency mining. Instead, it actually utilizes crypto coins instead of computing power to forge a block instead of mining it. And this is the terminology used for staking. So to do this, funds are deposited onto a network computer, or a node as it's called, and these compete to forge the node. The winner is then picked randomly based on their stake size, among other factors, and we'll cover this a little bit later in the video. The winner then receives a reward in the coin that they have staked, since it's now verified a block of transactions that in turn will serve to strengthen the network. So they're actually paid as a reward in the actual coin that they're staking for ease of use. The coins that are given as a reward are newly minted through the verification process, and this sounds familiar because it's exactly like the mining process. This is what's called proof of stake. The traditional mining techniques actually relied on what's called proof of work, and you may have heard this term before. So this new version is the proof of stake. So proof of stake is proof that you've staked a coin and you receive a reward for verifying a transaction, where proof of work is proof that you've mined or solved a puzzle and you get a reward for that. So proof of stake is a new and improved proof of work because of the system it uses to choose the winner. Proof of work requires all miners to expend energy to solve a cryptographic puzzle, and only the first to solve it receives a reward. Now on the other side, proof of stake chooses one staker to solve the puzzle and rewards that staker. There's no wasted energy in this process, which is really important. Staking is the method by which the proof of stake networks verify and post transactions to the blockchain. So it's very important for the integrity of the entire blockchain and that network. As there are miners for the proof of work network, for the proof of stake network, they're referred to as validators. And one validator actually solves the puzzle while other stakers verify their work. So they're all working together to make this network more safe and effective. So a rather interesting one is Ether or Ethereum staking. So since 2021, Ethereum has two blockchain networks operating side by side. The 1.0 blockchain operates with a proof of work model, and the new 2.0 blockchain utilizes the proof of stake network model, and this is all very new. So when you're staking Ethereum, the staker actually earns a percentage of the newly minted coins that are created through that proof of stake. The more people are staking, the smaller the percentage you receive. And again, this is negative, as you want to receive as much reward as you can. So in order to be a proper validator, you actually need to lock up 32 Ethereum coins on one node. So if you want to earn more by staking, you will need to stake more than one node. It's worth noting that the 32 Ethereum serves as collateral for the validator in case they do a poor job solving the puzzles, and again we'll talk about this a little bit later. This creates a substantial barrier for entry, as you can imagine, because each Ethereum coin is roughly $3,000. So in 2022, not exactly what date yet, Ethereum 1.0 and 2.0 will actually merge into one in an event known as the docking. It's important to note that validators cannot withdraw their collateral from staking until the docking occurs, so they're stuck with that 32 Ethereum in the network until this happens. There are 900 new nodes allowed to be staked on a daily basis, so there's a long wait time to become an Ethereum validator. So currently there's thousands of people waiting to be a validator for this. So now we can take a look at some methods of staking. A very logical alternative to being a validator is to simply stake through the use of an exchange, and this is kind of the main function of staking here. An exchange serves as the validator for the network, so you don't have to post up 32 Ethereum as collateral, for example. So this is in the case of Ethereum, and with other coins, similar amounts are needed. This does limit the amount of control you have over your coins, and it also means you lose some of your rewards in fees. But this is to be expected if you do it through an exchange. Using an exchange actually does not lock up your coins, and this is a very important point because especially for Ethereum, you don't need to wait for the docking. It's simply putting them to work and earning you interest on your long-term crypto investments. This is especially true of holding long-term. Again, as I said, you reap extra benefits by doing this. And this can be seen as a kind of covered call if you watched last week's video, in the case that it's an income strategy, but much simpler. Like mining pools, for proof-of-work networks, there is the option of joining a staking pool, which requires a much smaller coin staking investment or collateral. And this can be a good way to do it as well. It does require some deep research about the pool's reliability and safety in terms of your investments, and there's also usually pool fees that should be taken into account when doing this. And finally, you can also opt to use a type of validator service that's now available that actually provides you with the entire validator computer setup and whole rig system, but it also requires that you post up those 32 Ethereum coins as a deposit to do so. It does let you maintain control of your coins while staking though. Now let's take a deeper look at exactly how staking works. At any one time, there is only one validator that's verifying a single transaction. And again, this makes it very energy efficient in this way of doing it. It's also much safer and more resistant to cyber attacks than proof-of-work networks. It's very important for the validator to solve the puzzle correctly, however. If not, choosing another validator wastes valuable energy and time, and as we know, time is money in any capital market. For this reason, if the puzzle is solved incorrectly by a certain validator, that validator is then forced to surrender some of their collateral, i.e. paying them as a punishment. So you're losing some of that collateral instead of making a reward. And if it's solved correctly, they are rewarded for their efforts. So this just makes sure that all participant values are aligned, and it's not necessary if staking through an exchange. Staking is simply the act of serving up your coins and waiting to be chosen in order to verify transactions to secure the network. So essentially you're just giving your coins to an exchange or to the actual network and waiting to be picked to stake and earn rewards. You essentially aid in updating a digital transaction ledger. The criteria for which staker and validators will be allowed to stake is actually pretty complex. Now the main constituents include the age of the stake coins, so how long you have them staked, and the amount of coins that are staked by one validator at a time. So this essentially shows that the validator is reliable in solving cryptographic puzzles and that they do it correctly often. There's also a random number component to avoid bias and staking firms and allow small investors to also stand a chance and earn some rewards, which is a good way to do it. As with anything we discussed, there are some downsides. So depending on the staking coin or exchange that you're using, some may actually require a minimum holding period for the collateral coins. There could be months or years or weeks depending on what coin it is, and this can be an issue. There's also quite large barriers to entry, for some of which include needing the extensive technical knowledge to become a successful validator. Some of these skills include things like being able to code, setting up a crypto wallet properly and being able to use it, having a crypto brokerage account and knowing how to navigate that, and actually setting up a staking computer rig. Now this is only, of course, if you want to be a validator yourself and you don't want any other firm to do anything for you. So this is only if you DIY it. The time needed to unstake your coins may be an issue to quickly liquidate your position. Some may take up to a week to free up your coins. And again, this can be a problem because, as we know, crypto is very volatile. So if prices move a lot, it can be quite painful to watch this, knowing that you can't get out. But it's great if you're a long-term investor and don't really mind the short-term fluctuations. And finally, some coin networks or exchanges can be slow and up to 1 week to pay out staking rewards. So if you wanted to use these for something, that can be an issue as well. Now, the most popular ones that are popular in society today is the Tezos, which is the first one, which has a 6% staking reward per year. There's also Cardano, which is 4 to 5% per year. Algo, which is 8 to 10%. And finally, Ethereum, 4 to 7%. So as you can see, some of these actually return quite significant amounts per year. And now we can put it together. So overall, staking is a great method to earn some passive income from your crypto holdings that you already own, since interest is paid annually as a reward for doing so. And the funny thing is that this alone may actually beat annual stock market returns on average, which, if you do something like Algo, is 8 to 10%, which is more than the S&P returns on average. But you are limited, however, to choosing coins that utilize the proof-of-stake network model. It can also be a great way to support coins you believe in, since staking strengthens the reliability and security of that coin's blockchain and network, so you can show your support in that way. Some research should definitely be done to determine whether staking is right for you, or whether you should become a validator or simply stake through an exchange for a fee. And of course, this depends on your technical ability and your willingness to learn how it works. Long-term crypto investors should definitely consider staking as a form of passive income. And I'll see you all next week.